For many people, the stock market is starting to feel overvalued again. The S&P 500 is close to all-time highs after a very roller coaster start to 2025. But now many stocks out there are hitting all-time highs, and I think it's safe to say that we're back to a bull market. And if we're not, we're very close to being in one. Now, despite this seemingly high price for the S&P 500, remember that there are always pockets of the market that will have dislocations in prices. As an active investor or a stock picker, in other words, you are never buying the entire market. You are buying individual companies. And so your job, instead of focusing on macros and the market, is to look at these businesses on a fundamental level, a microeconomic level, and figure out if there are any dislocations in price versus value. And let me tell you that there are always opportunities to generate alpha in the market. On the rated A database, we currently track about 50 high quality companies from all around the world. And out of those 50, five are being currently flagged as good opportunities based on their free cash flow valuation. That means that their value rating is above 80. And another five are being flagged as good buy opportunities based on their dividend valuation. That means that the income rating is above 80. Now, these two different profiles of companies will appeal to different types of investors depending on where you are in your career. But what it means is that there currently are good opportunities in the market at the moment. At the company, we've been buying three different stocks over the past few months. These stocks are LVMH, Evolution, and Alphabet. But before we get into that, I just want to spend some time here and do a quick update of the portfolio, starting with the performance. This chart starts at the beginning of 2025, which is when we started tracking the performance of the rated A holdings portfolio. Our portfolio is represented by the blue line. The green line represents the MSCI World Index, and the yellow line represents the S&P 500. Clearly, we're doing really well this year. The portfolio has shown a performance of 14.6% versus 6% for the MSCI and 2% for the S&P 500. So far, so good, but like I usually say, 6 months is still way too early to judge the performance of this strategy. You'll hear me say this again and again, whether I'm beating the indices or trailing them, at least until we get to around 5 years of performance history. I believe 5 years is kind of the threshold where you can start judging a strategy, whether it's underperforming or overperforming. But even 5 years is kind of short. Some strategies go in and out of favor over the overall business cycle, and sometimes that can be 5, 10 years at a time. Now, turning to the holdings in this portfolio, British American Tobacco and Visa are still by far the two largest positions in here. Both positions are around 20% of this account, which for a lot of people would be above their limit of what they're willing to allocate to any given company. 20% tends to be my personal preference. I'll let the winners run above 20%, but if a company is 20% or more of the portfolio, I probably won't be adding any new money into it. In terms of other important positions, we have S&P Global, Paychecks, Automatic Data Processing, Evolution, Euronext, and LVMH. And then we have some less important positions, starting with Broadcom, MasterCard, NASDAQ, Google, Oracle, Microsoft, Philip Morris, MSCI, and Intercontinental Exchange. All the companies in this portfolio are very high quality. They're rated as either A or B on the rated A database, all except for one. And funny enough, that one company that is not rated as high quality company is British American Tobacco, which is the largest position in this portfolio. So why is it there? That's a great question. The answer is valuation. Even though the company is lower quality than the rest of the portfolio, I was buying into it when the free cash flow multiple was around 5 or 6 times. The dividend was around 8 to 9%. And so even though the company is slightly lower in quality, the value rating was super high. If we look at the portfolio movers, the companies that have contributed the most to my portfolio's outperformance are British American Tobacco and Visa, not surprisingly. because they're the largest companies in the portfolio and they've been performing pretty great this year so far. In terms of the bottom performers, we have LVMH, MSCI, and Evolution. Now, like I mentioned before, I'll be talking about Evolution and LVMH because these are the newer buys in the portfolio. These are the ones I've been buying the most of in the past 3 months. Yet, for now, they're the ones dragging the performance of the portfolio down. If we just want another perspective on this, I've changed it from time weighted return to money weighted return. You can ignore the currencies here at the top. We have Swedish krona, USD, GBP. These are just whenever I make a transaction in IBKR. So ignore those positions. We can see that the best performing companies in the portfolio this year are Philip Morris, Euronext, and British American Tobacco. Philip Morris is benefiting from huge traction in their nicotine alternative products like the IQOS and ZYN. Euronext is like the Nasdaq of Europe, so obviously that company is benefiting a lot from the European trade. If we turn to the worst performers, once again, we see that LVMH and Evolution are top of the list. LVMH is down 21% this year, and Evolution is down 12% this year. So without further ado, I'm now going to go over these companies and see where I'm at in my mind, if I'm going to be buying more or what's next. So let's start off with LVMH. This is a company that I've done a full report on previously. The video is 24 minutes long. It was posted 2 months ago on this channel, so do check it out if LVMH is a company that you're interested in. Since I made that video though, the stock is down around 20%, so quite a bit. When a stock is down 20%, that's the time to question yourself. One of two things. Either you realize that your thesis was wrong and you change your mind about the stock, or you double down. In this case, clearly I'm doubling down. I think that LVMH was a good opportunity when it was 575 euros per share. So now that it's 475 euros per share, I think it's an even better opportunity. LVMH is now close to 50% off from its all-time high, and the stock just can't reach a bottom. It just keeps going lower and lower and lower. From 2020 to 2023, when I was first looking at the stock, the multiple on the free cash flow was in the mid 30s. Today, that multiple has come down all the way to 17.66. So that explains the 50% drop. There's a few key metrics that I like to look at for a really 500-foot view of any company. The first is the revenue. How much is the company selling of the product? Clearly, when it comes to LVMH, the revenue keeps going up and up and up. If I just look at this chart, I wouldn't imagine that the stock of this company would be down 50%. The operating margin is another financial metric that I think is really important. The margins are staying relatively stable, so nothing to worry too much about over here. And then finally, I look at the free cash flow. From a free cash flow perspective, it does look like LVMH went through a little dip in 2023 and then is back off to the races in 2024. 2024 was the second largest year ever in terms of free cash flow, only behind 2021. So clearly the trend is there. Once again, this is not a stock that you would think is down 50%. So looking at the financial metrics clearly doesn't explain the drop in the stock price. So if it's not a fundamental thing, it has to be a narrative thing. That means the story about LVMH has changed. Investor expectations are now lower than they were before. Luxury companies like LVMH or Hermès, Kering, they're cyclical companies. They sell more of their luxury products when the economy is doing good, when people are feeling rich. We also know that China is a very important market for all these luxury companies, including LVMH. And we know that China has been going through a really tough time over the last 2-3 years. They're going through a severe recession called by a real estate implosion, and the consumer in China is just not feeling very confident. So LVMH is seeing its sales go down in China. And then there's also the anticipation of a recession hitting North America and Europe, especially when it comes to tariffs. Trump announced some pretty large tariffs on Europe There hasn't been a deal as of today. It's currently June 4th. There hasn't been a deal between the EU and the United States. And so everything coming out of EU to the United States, exported to the United States, is going to be taxed at around 15 to 20%. For LVMH, that's a bad thing. What the management at the company has said is that they only have a limited amount that they can increase prices to pass along the price of the tariffs to the consumer. Myself, knowing what types of products are sold by LVMH and the type of people that buy LVMH products, those people tend to be pretty rich. So when the price of an item goes up, if anything, it makes it more desirable. But people are expecting that LVMH will be selling less products in the US. And so this expectation is driving the multiple down and hence the stock down as well. Everything I just mentioned is a short-term problem in my opinion. Everything that comes to the economy, to taxes, to politics, all of that is short term. It has nothing to do with LVMH's brands, their pricing power, or anything of the sort. That being said, there is one element of LVMH's business that might be in a long term secular decline, and that is alcohol. We'll get back to that in 1 second. Because first, I want to look at LVMH's Q1 revenue results. They only report the revenues. If we just focus on the total down here, we can see that the revenues for Q1 were down 2% from 2024 to 2025. Once again, this shows a slowdown in sales, but you wouldn't expect a company that has its revenues go down 2% to lose 50% of its stock price in just a few years. Out of all these categories here, I think that wines and spirits might be the one where LVMH might have some long-term trouble ahead of it. That's due to GLP-1 antagonists hitting the market. Studies have shown that people's appetites go down, but also their desire for alcohol, gambling, and other addictions like this. People are just getting healthier as well, and there are some trends, especially among millennial and Gen Z, to drink less overall. So we can see that out of all the categories, the wines and spirits was hit the hardest this Q1, going down 8% since Q1 of 2024. There's two things I really want to say about that. The first is that if alcohol consumption does go down, I think LVMH's brands like Moet, Chandon, Dom Perignon will be the ones that are less affected because people consume these alcohols to celebrate during birthdays, during anniversaries and weddings. I think that if people start drinking less, this is not the part of their alcohol consumption that they will curtail. I think it's more likely to be beer, going to bars, pubs, and those types of things. The second thing that's worth mentioning is that at the end of the day, wines and spirits is a small percentage of LVMH's total sales. Just doing some quick maths here, it seems that this segment is approximately 5% of total revenues. If wines and spirits keeps going down and say revenues goes down another 10% in the next few years, it's really not the end of the world. And keep in mind, LVMH is still a cyclical company. They are going through a downturn at the moment, but this is a long-term game. LVMH, at the end of the day, is a family-owned business. It's owned by the Arnault family. This family doesn't care what happens in Q1 or Q2 of 2025. They care about where will the company be in 2030, in 2040. And so today they're making the moves and the investments that are needed to be ahead of the game 15 years from now. My prediction is that there's a very, very, very high likelihood that 5 years from now, LVMH's cash flows will be higher than they are today. So I've gone ahead and filled out this total shareholder return calculator for LVMH. I've put in today's share price, current revenues. I've input a revenue growth rate of 5% for the next 5 years, which I think is very doable. I've kept the margin at a level where it's been at in the past 10 years on average, so 15%. No share buybacks, a terminal multiple of 25. I've put in the current dividend, a dividend growth rate of 8% per year over the next 5 years. 100% of dividends reinvested, and we get a 16% total shareholder return. there you have it. In my opinion, these are fair assumptions, quite conservative assumptions. The rated A database is flagging LVMH as a very high quality company that has a very high value rating, a high income rating. It's a buy. Both signals are buy. So that's what I'm doing. I'm just buying more of this company and we'll see where it goes. The next company I've been buying is Evolution. Now, just like LVMH, I already made a video about Evolution. This one was 4 months ago. It's a 23-minute long video. In it, I lay out my full investment thesis on Evolution, the moat, the risks, everything you need to know. So definitely go check it out if you want more information about Evolution. Just like LVMH, Evolution is having a very, very difficult 2025. The stock is down 25% year to date. This is another company that just cannot find a bottom. And actually, you can see this really big drop in one day from 835 to 674. That 20% drop happened after the company released its Q1 earning report. Basically, the one thing that you need to know about the report is this chart. Everything is in this chart. This right here is what's spooking the market out. So first thing is we look at revenues and they are down from last quarter, even though they are slightly up from Q1 of 2024. So year on year, the revenues are slightly up. Quarter on quarter, they are slightly down. If we look at a very long trend, if we look at revenues year after year, for example, instead of quarter by quarter, we can see that the long-term trend is intact. Revenues are growing every single year. There hasn't been a single year where Evolution saw a drop in revenues. But the one thing that people are focusing on is this drop in revenue growth. So even though revenue is still growing, that growth is decreasing every single time, basically. In the 2010s, revenues was always growing at 20 to 30% year over year. Well, in this most recent quarter, the revenue growth was just 4%. The question is this revenue going to keep decelerating and maybe turn negative at some point? The second troublesome thing is the margin, which also keeps coming down quarter after quarter. Even though having a margin of 65% is still extremely high, that's a drop from where it used to be, closer to 70%. So this drop in revenue growth, decelerating revenue growth, and the drop in margins is causing investors and the overall market to re-rate Evolution stock. Evolution was seen as a high growth company, and back in 2021, the multiple was very highly elevated, and that multiple is just contracting. And today we've reached a point where the free cash flow multiple is at 10.66. So investors have soured on this company. There is no more momentum. The momentum trade is dead. And even some value investors are giving up on this one and rethinking their entire investment thesis. Now, there are three main issues to be aware of with Evolution. The first one is the USA expansion. Evolution is in a great spot in the US. It is nearly a monopoly, but the US works a little differently to the rest of the world. Every single state is different. Every single state has its own regulation. And for Evolution to have a presence in each state, it needs to open a studio and hire people to work in those studios. And as you'll be aware of, the US is not the cheapest place to build things and to hire people. So Evolution is in a investment phase at the moment, and they are spending more and more money opening up and building that presence in the US. While they're doing that and gaining revenue from the US, their margins on the US portion of the business is also decreasing because now they have to pay more for all these expenses. The second thing that's worth noting for Evolution's business at the moment is the cyber attacks that are happening in Asia. And management keeps talking about these, and unfortunately, they haven't found a resolution to those yet. So this is an ongoing issue. And what's happening is that in Asia, people are finding ways to hack into the stream and then sell that to casino operators without paying off Evolution. And yeah, it's just a big headache for the management of Evolution. The third, and I would say the most important thing to be aware for Evolution, is the UK Gambling Commission reviewing the license of Evolution. And this has caused some panic from some investors. But Evolution is working with the UK regulatory body, and what they're doing is something called ring fencing. Evolution is present in regulated and unregulated markets. And in Europe, what they're doing is getting rid of all their suspicious, unregulated clients. And really, they're doing this to be on the safe side. I think this is a good thing for the long term. But what it's causing is a drop in European revenues for the first time ever. So, of course, this is a really bad look for the company, but it's almost like they're bringing down the revenues to start from a new base where they can grow from in the future, or at least in theory. We can see that Asia is also going through some problems for growth, but North America is doing really well. When you compare this quarter, sales were 71 million compared to 62 million last year. The reason why I'm still buying Evolution is because I think all three of these issues are short term. Once Evolution has its presence established in the US, their margins will eventually get back to where they were as they're able to scale on those fixed costs that they're building. Ring fencing is a similar situation. Once they've gotten rid of all the bad actors and on the unregulated clients, then hopefully revenues will start growing from there once again. The one I'm more iffy about is the Asian cyber attacks, but I think eventually with technological intervention, they'll find a way to bypass this problem. And if we look at cold hard facts, Evolution is a company that has seen double-digit revenue growth since it went IPO in 2013. It has an operating margin of 69%, return on invested capital of 29%. It's paying out a dividend of 4.72%. It has a multiple of 10.6, and it's a high quality company, B rated. So once again, the database is flagging this as a value buy and an income buy. Now, when a company is of that high quality and trading for that cheap of a multiple, what you want management to be doing is to take the free cash flow and buy back shares. Buy back as many shares as possible. Well, although management is not buying back as many shares as possible, they are buying back shares. And let's just say that the money they're deploying is going farther the more the stock price goes down, because they're able to buy more shares with the money that they have available to deploy. So, this concoction of all the factors that I just mentioned is the reason why I'm not too worried about Evolution. That being said, I'm not sure I'll be buying that much more at these levels, despite it being a good potential opportunity. That's just because it's already 5 to 6% of my portfolio and maybe a bit on the riskier side. So for me, this is more of a wait and see as of now. Even though I've been buying this company for the past 2-3 months, I'm going to be waiting for Q2 and Q3 results to see how management fares. I'll be spending the remainder of this video talking about Alphabet, aka Google, and why I've been investing in this company. At first view, it doesn't seem like the typical profile of the companies that I like to invest into. Yes, it's extremely high quality. Actually, Google is one of the few companies on the database that has a perfect component score for moat, profitability, and safety. It's one of the highest ranking companies out there in terms of quality. That being said, it's still trading at a high multiple when it comes to the dividend or when it comes to the free cash flow. So this company is not cheap by any means, even regardless of its quality. Optically, it seems like the company's free cash flow multiple is really high. But if you dig just a little bit deeper, you can see that that's actually because the company is making huge capex investments. 52 billion in 2024, and this number is expected to go to 75 billion in 2025. So while the operating cash flow is increasing very nicely year after year, the free cash flow is being held back by this capital expenditure figure over here. And so when you look at the free cash flow chart, it doesn't seem to be increasing as quickly as the operating cash flows. How is Google spending all of this capital expenditures? Well, they're investing in Waymo and growing that service. They're also building out all the infrastructure for all the public cloud that they're trying to build out. And they're investing in AI and bringing out new products to the public that are going to be adopted and hopefully grow to compete with ChatGPT and other LLMs. If you look at the entire market right now, there are very few companies that are investing this much into their own business. Google simply invests more than any other company out there, bar a few like Microsoft and Amazon. My thesis with Google is that these capital expenditures are going to have extremely high return on investment. Not only that, but I think that at some point in the future, these investments will plateau and slow down. And at some point, Google will start reaping the rewards for all this investing and actually start collecting mountains of cash. The market sees things differently, with the stock being down from its all time highs by almost 20%, PE ratio of 19, so way below the market. And my theory is that this is all because of uncertainty. Investors hate uncertainty, and Google has lots of uncertainty around it, starting with two massive DOJ lawsuits. And by the way, Google has lost both lawsuits officially. The company is going to appeal most likely, but now the judge is trying to figure out a remedy. It is yet to be known what that remedy will be. The first lawsuit is surrounding Google's search business. Basically, it's alleging that Google's search is a monopoly. And there are two remedies that are being floated around. The first one is that Google is going to have to stop paying Apple to be the default browser. Right now, Google pays Apple billions, tens of billions of dollars annually to be the default browser in the iPhone. So when you open up Safari, the first thing that comes out is usually a Google search bar. This brings in tons of traffic to Google, and the authorities have said that that's anti-competitive. The second, and probably the more painful one, might be that Google has to divest Google Chrome. Obviously, that would be very painful for Google because the company has invested a ton of money and many years into creating this service that's seamlessly integrated with other Google services. So the company's lawyers are fighting really hard for that not to happen. I think the consensus is that there's a very small chance that this will actually happen. Google also lost a lawsuit that alleged that its advertisement ecosystem was a monopoly. Same as the other lawsuit, one of the remedies that's being proposed is the dissolution of this ecosystem. Google might have to divest either the buy side of the platform or the sell side or the ad exchange, where the exchange actually happens and companies bid for ad space. Once again, I think the consensus of that actually happening is really low. What's more likely to happen is that Google will get a slap on the fingers and will have to be more transparent with the process of how it auctions that space to other companies. But that's where we are right now. The market really hates uncertainty. Investors also hate uncertainty. That's why the company is trading for a PE ratio of 19. I think the company won't be re-rated until the remedies for these lawsuits are fully disclosed. I'm of the opinion that even if Google were forced to divest some of its businesses, as a shareholder, you wouldn't be that much worse off. History has shown with the splitting of AT&T and Standard Oil that shareholders are actually better off when a monopoly gets split into smaller entities, and that these smaller entities that compete against each other tend to have better returns over time than the original larger company. So I don't see why that wouldn't be the case again. If you own Google today and they're forced to divest Google Chrome, you'll still be the owner of Google Chrome. It'll just be two companies instead of one. As if that weren't enough, Google is also seeing increased competition by large language models like ChatGPT by OpenAI. Studies have actually shown that Google is losing market share to these smaller and newer players on the market. And so, for shareholders that were used to Google having 99% share of the search market, this comes as a pretty big blow because Google's search business is the cash cow. It's responsible for 50% of profits. That's a big blow for shareholders because Google's search engine is the cash cow. It's responsible for 50% of revenues and an even larger percent of profits. Personally, I think this is the wrong way to think about it. Yes, these LLMs are taking market share and taking an overall larger percentage of the pie, but the pie is growing. The entire search market is growing fast enough that even if Google is losing market share, its overall volume of the pie is still growing. And we can see that in the numbers. Google's search revenues went from 46 billion in 2024 to 50 billion in 2025. Revenues are still growing, margins are still incredibly high. This is still a cash cow, even though ChatGPT has been out for 2-3 years at this point. I think this market is large enough and profitable enough that many players can succeed. Remember, in the market, there's the narrative and then there's the facts, and this is the facts. On top of all of that, there's Waymo. I think Google is one of the companies with the most optionality in this market just because of Waymo. I mean, the total addressable market, if Waymo ends up being successful, is massive. And right now, Waymo is winning that race. It's far ahead of Tesla in the race to bring autonomous driving and autonomous taxis to the market. Waymo's already deploying cars to many different North American cities. They're having 250,000 rides per week. Competition with Tesla might heat up in the next few months, but Waymo has partnered up with Uber and they're well positioned to really win this race or be one of the top 2-3 players. For those of you that haven't watched it yet, I recommend watching this Google I/O 25 keynote. It's really incredible the amount of features and AI products that Google's coming out with. It seems that they're starting to compete head on with other big tech companies like Adobe, Apple, Meta, and they're not focused on being profitable. They're just focused on providing value to the end user. And then once they provide that value, they'll just figure out a way to make it profitable and to monetize it. Sundar Pichai actually makes a reference to Gmail. When Google brought out Gmail in the early 2000s, it wasn't something that they were able to monetize from the beginning. But eventually, as Gmail got more and more popular, the entire Google suite came out of that. And today, it's a really, really profitable franchise. So there you have it. That's the big picture view of why I've been buying Alphabet in the company portfolio. That's it for today's video. I'll see you in the next one.